there's points in history where you have forward guidance from the Fed and they tell you what they're going to do over the next 6 to 12 months, and it's pretty certain. And then there's other times in history where there's really no certainty at all, and you don't know what monetary policy is going to look like, and that's kind of where we are right now.
Welcome to Wealthion. I'm Andrew Brill. We have a new administration, and we'll talk about the effect that will have on the economy and markets right now. I'd like to welcome back Jared Dillian to Wealthion. Jared's a veteran of Wall Street, an accomplished author, a musician, a DJ, a veteran, author of the Daily Dirt Nap, and an educator. I'm sure I left a few things out. Jared, welcome back to Wealthion.
Hey, good to be back. Thanks.
Absolutely. So you're teaching a new class now. How's that going?
It's not a new class. I mean, this is the third time I've taught this class. It's personal finance. But we've had one class. It's going well. It's funny because I kind of do the good cop, bad cop thing. I kind of lay down the law in the first class, and everybody's like totally intimidated, and then later on in the semester they figure out like I'm a big teddy bear, and it's So
you're trying to explain to kid, don't keep your money under the mattress. You gotta take care of yourself, like our grandparents once did.
Yep.
So, Jared, I was, first of all, welcome to a new administration, and what are your thoughts on the economy as we sit here today?
Well, we're recording this on Friday, January 17th. We just had some incredibly strong housing data. And, you've probably seen in the last couple of days that Christopher Waller, who's one of the Fed governors, he's agitating for several more rate cuts in 2025. And Waller is like, he's not a political hack. Like he's a real guy. He's an honest broker. And I'm kind of wondering, like, what is he seeing that I'm not seeing? Because all the data I'm seeing is super strong. And anecdotally, the economy seems to be strong. On the other side, you have Beth Hammack, who's the new Cleveland Fed president. And, she's been saying lately that, inflation is still high, which it is. It's 2.9%. And there's still inflationary pressures, and she's agitating towards higher rates. So it's going to be interesting to see what happens. And then, of course, after the inauguration, Trump takes office, and we all know that Trump wants the Fed to lower rates. And is this going to be a repeat of 2017, 2018, where he was dumping all over Jay Powell to get him to cut rates? So I would say, there's points in history where you have forward guidance from the Fed and they tell you what they're going to do over the next 6 to 12 months, and it's pretty certain. And then there's other times in history where there's really no certainty at all, and you don't know what monetary policy is going to look like, and that's kind of where we are right now. So
how is it that two Fed governors can take a look at it? And look, the Fed's mandate was always 2%, 2%, 2%. We're 2.9% at this point. How is it that two Fed governors can look at it and say, no, we have to go this way or we have to go that way?
I don't know. It's really strange. Especially when you consider that, we just did 100 basis points of rate cuts. The last one was considered to be a close call, right? In which Beth Hammack dissented on in at that meeting. She was actually a dissent. So, once in the 50 basis point rate cut that kicked it off was the Fed panicking about unemployment. So I don't really see how you get 100 basis points of rate cuts in 2025 unless Trump really leans on the Fed, which is possible. So,
but you think Jay Powell will give in to the pressure from Donald Trump? Because it doesn't seem like he's ready to do that just yet.
No, I mean, from his language and his body language, when he was asked that question at the press conference, if he would resign, if Trump asked him to resign, and he just said no. and he seemed kind of annoyed by the question. Powell is termed out. He's not going to be. He's not going to be Fed chair for another 4 years. Like, he's retiring. Like, he knows this. So I think he's in a position where he can tell Trump to go pack sand, but
or something else.
or something else. Yeah.
So we had a PPI that came in and the market was ho-hum. CPI comes in and it didn't seem to move. It's still at 2.9 and the market goes crazy. Can you explain to us why it went on a run like that?
Yeah, I can try to explain that. So first of all, I think that what happened was when PPI was released, it was softer, and you got a rip in bonds that lasted a couple of minutes, and then they sold off again. I think the market really didn't believe the PPI print, and then when it was confirmed by the CPI print, also keep in mind, bonds have been selling off relentlessly since like October, September. Tens are, I don't know, 80 basis points higher. You've had this big bond bear market. And, what I think is that positioning in bonds is very extended. I think there's a lot of shorts. I really think it was short covering when CPI came out. Like, people just had to cover. I still think that positioning is very short. I don't think we've seen the low in bonds yet or the high in yields. I think we have to make a little bit higher high in yields. I say that for technical reasons, and I say that because I think you're going to get some language out of the Trump administration in the first couple of weeks. They're going to be talking about extending the tax cuts. They're going to be talking about more tax cuts. They're going to be talking about things that will expand the deficit. And I think those are going to be scary headlines for the bond market. So I don't think we put in a top in yields just yet. Almost, but not quite.
Thanks so much for watching our discussion here on Wealthion with Jared Dillian. If you would like help with your wealth efforts, please head over to wealthion.com/free for a free portfolio review. So you think that hang on to your hat, you might be able to get bonds at a better price.
Or
I should say, if you buy them now, you might be able to get a higher price in a few weeks once these policies come out.
Yeah.
So bonds, the rate curve has inverted back. So the long bonds are much higher. The 10-year is higher. The mortgage rates are higher. Jared, what are you expecting for inflation? Because right now, 2.9%, tax cuts, tariffs, all of this seems inflationary. And eventually the bubble's going to pop and they're going to have to raise rates again.
Yeah, I mean, that is the conventional wisdom that everything Trump wants to do is inflationary. And the question is, whether that's priced in. If you go back to the election, on election night, when it became clear that Trump was winning, the bond market sold off pretty relentlessly. And then it rallied for like 2 weeks. It rallied for a couple of weeks, basically on the idea that Scott Bessent was going to be Treasury Secretary and he was safe hands and he was going to cut the deficit. And then bonds started selling off again. So the curve, last I checked, was about positive 40 basis points. And 12 months ago, it was about negative 30 basis points. So the curve has steepened a bit in the last year, and it's steepened a lot in the last couple of weeks. The Trump steepening, which everybody has been waiting for, where short-term rates come down and long-term rates come up, I mean, that is the trade that should happen once Trump takes power. And people have been waiting for that for a long time. I'm a little bit skeptical. That is a very crowded trade. There's a lot of people in the steepener, and crowded trades generally don't work. But theoretically, that is what's supposed to happen.
Do you see, Jared, because the long bond is going up, do you see people leaving the market or taking money out of the stock market, putting it into a safe place like bonds?
No, I don't see that at all. it's what's interesting is that we're if you want to talk about stocks, um, you've had some rotation in the market. Apple, which is the biggest stock by market cap, is down 12% from the highs, which is an enormous move. And stocks are down maybe 2 or 3%. Nvidia made new highs. There are other stocks that are making new highs. Tesla is going up. So it's kind of interesting. I don't think people are taking their money out of stocks at all. I think you'd have to get rates significantly higher in order to get people to de-risk. I think you'd have to see like money market rates at like 6% before people, start taking money out of stocks. And at 4.5%, that's not going to do it. So
We talked about the yield curve, and in your daily dirt nap, you talked about yield curve controls, which you didn't think would happen for quite some time, but it's sort of something you're pondering now. Can you explain what yield curve controls would be and why they may happen sooner than you thought?
well, so yield curve control we actually did in the 30s and 40s. And what that means is that the Fed will say, okay, the 10-year note is going to trade at 3.5%. So they cap the rate at 3.5%, and they buy all 10-year notes at 3.5% in order to maintain that cap. And it's incredibly inflationary because they're literally printing money to buy bonds at that level. And they can cap at any point across the yield curve. So back in the 30s and 40s, interest rates were much lower. They capped the 30-year bond at 2%. And after yield curve control ended, after World War II in 1946, inflation shot up to about 18% for a short period of time. So it is very inflationary. The reason I think it might happen soon is because, first of all, I think Trump knows that he can beat up the Fed and lower short term rates. But you saw what happened a couple of months ago. We lowered short term rates and long term rates went up and the curve steepened, right? So the bond traded at 5% the other day. If Trump really wants to affect mortgage rates, he's going to have to lean on the Fed to do yield curve control to hold long term rates down. And like I said, I think this is a low probability, but I think with the bond at 5%, with mortgage rates at 7.5, the likelihood of this happening, I think, is going up. I think there's maybe a 10% chance of it now, where there was a 0% chance last year. So could be interesting.
Do you think the administration looks at the housing market, the price of houses, the mortgage rates, and say, hey, look, we need to stimulate this a little bit and bring housing prices down? Do you think that's one of the reasons why he might look at the controls?
Well, yield curve control would make housing prices go up, right? Like that would, if mortgage rates go from 7.5 to 6 or 5.5, that makes houses more affordable. So housing prices would go up. It definitely would not make the housing market cheaper. What it would do is make it more accessible to first-time home buyers. But really, what I think we've seen in the last couple of years is sort of a supply side revolution when it comes to housing. It's very interesting because even left wing mayors and city council chairmen and local government people acknowledge that increased supply of houses bring housing prices down. So all the NIMBYism that you saw in the 2010s is giving way to YIMBYism, yes, in my backyard. And, there's been a lot of pro-growth housing policies put into place that are allowing for stuff to get built. I mean, here in Myrtle Beach, they have built so much. I mean, we have a huge migration into the area, but they've actually built so many houses that housing prices are not going up. They're actually going down a little bit. And it's because of that supply. They brought so much supply onto the market. So that's happening everywhere. So that's a good thing.
I was reading about banks and forbearance on people who can't pay their mortgages. and how the lack of supply has a little bit to do with the banks saying, look, you know what, we don't really want to foreclose. So they're putting people into forbearance until their situation gets a little better. Have you heard about this? And how does this affect the market? So if the banks decide at one point, you know what, we are going to foreclose, sorry, we have to take your house. Couldn't there be a glut on the housing market and then all of a sudden prices plummet?
I haven't heard of any of that, but I can tell you that it wouldn't take much of a downturn in the economy to cause a huge number of foreclosures, right? So one of the things we've seen is that the savings rate is going down, that consumer credit is going up, that people, and this is largely as a result of inflation, but people are more strapped for cash. And if you saw a slight downturn in the economy and unemployment went from like 4.5 to like 5.5 or 6%, you would see a lot of foreclosures and it would have an effect on housing prices. It would be deflationary.
So unemployment is something that the Fed looks at very, very closely. And it seems that there are some layoffs coming. And do you envision that unemployment does go up? And look, I know that Trump and his tariffs is going to try and create manufacturing jobs, and that happened in a short term, his last term. But I have to believe that at some point inflation is going to tick up. They keep revising these numbers anyway, so you're not sure who to believe at this point.
Well, I think there are going to be some job losses in the public sector. I think you're going to see, tens or hundreds of thousands or even millions of jobs destroyed, at the federal government level and maybe even at state and local government. And that is going to have an effect on the economy. I think it's going to have an effect on some, specific geographic areas. Like I think, the DC area is going to suffer in particular, which is good. But there's, and also the tech sector, a lot has been written about this. Tech has massively overhired for a whole bunch of reasons. But, Google has 180,000 employees, which is insane. Even a company like DocuSign has 3,000 employees. Why the hell does DocuSign need 3,000 employees? So there's a lot of bloat in tech, and not just, there's really bloat in all areas of the economy. And if we ever did hit a speed bump, you could see layoffs happen very, very quickly, very quickly. We could go to 4% to 6% in a heartbeat. So,
we talked about the price of bonds, and obviously that has something to do with the debt. And do you expect that Doge can actually cut enough out of the government? Look, you're talking about laying off a bunch of government workers. Do you think that there's enough there to offset some of the spending that the new administration wants to take part in?
I actually do. I think there is. During the pandemic years, the government expanded quite a bit. So we have a $7 trillion budget right now, $7 trillion in spending. I want to say that in 2019 it was about 4.5 trillion. So it's expanded by like 60% in 5 years, 6 years, and a lot of that really is headcount. It's funny because Canada went through the same thing. Under Trudeau, like he expanded the government bureaucracy in Canada massively. Canada, like the number of government workers in Canada has grown just exponentially. And I've heard stories of people like they don't even have to go to work. They log on like once a week. They have a second job. They have two paychecks. Like that type of stuff is happening here as well. There's a lot that you can cut an enormous amount of people, and you can take a big bite out of the deficit.
It's funny. It's like a two-pronged sword. You're creating unemployment, but at the same time, you're lowering the deficit. So does that balance things out as far as the economy goes?
Well, by lowering the deficit, theoretically, that's going to make the bond market happy. So you'll see rates come down, which is good for everybody. Um, it also, if you cut 300,000 people from the federal government, and over the course of a year or two, they find their way into the private sector and they're more productive, then that's also good for everybody. So I think it's a win-win.
What do you think Scott Bessent can do to help that situation? Obviously, he's going to take over for Janet Yellen, and he's got the task of servicing this debt. How do you think he attacks it? We know that Janet Yellen was short-term stuff, but how do you think Scott Bessent attacks this?
Well, the first thing he needs to do is he needs to change the password on that computer in his office. I can't even imagine what Janet Yellen clicked on to get her computer hacked. Probably some Nigerian prince thing or something like that. I mean, he's the first thing he has to really focus on is the weighted average maturity of U.S. Treasury debt, right? Which right now is about 70 months. Okay. So 5+ years, 5 years, 8 months, right? 10 months. The weighted average maturity of our debt is too short. I mean, this is the thing that Yellen screwed up. During the pandemic, when rates were sub 1%, she should have issued as much debt as humanly possible in 10s and 30s, right? As much as humanly possible. And it extended the maturity of our debt. I mean, basically, it's common sense. Just like millions of people did during the pandemic when mortgage rates went down to 2.5%, they locked it in for 30 years, right? If rates go down, you want to lock them in for as long as possible. She didn't do that. We financed the government mostly in bills and 2-year notes. So when rates went up, we were totally hosed. And that's why interest expense went from 300 billion to $1 trillion. So Bessent needs to term out the debt as quickly as possible. And if the auction size of bonds starts going from 40 or 50 billion to 90 or 100 billion, that's going to put a lot of pressure on the long end, which gets back to the steepening that we talked about earlier. Like I mean, 2025, you could see short-term rates come down, but you could see long-term rates go up a lot. So.
And that creates the problem. If short-term rates are down, you want to finance with those short-term bonds and not the longer term. So I guess, the steepening of the curve sort of plays against you at that point.
It does, yeah.
So I want to talk a little bit about the dollar. It has come down a little bit. In your daily dirt nap, you talk about you're sort of long commodities. You think that the weakening of the dollar will be very good for commodities. I know that, and Donald Trump makes no bones about it, that he wants to weaken the dollar a little bit. Is this why you're bullish on commodities?
Yeah, that's a big reason. I mean, look, like it's funny because we all know Trump wants to get the dollar down, but he hasn't said a word about it. It's crazy to me that nobody on the finance committee asked Bessent his views on the dollar. Like that's in a confirmation hearing. Nobody asked the incoming Treasury Secretary his opinion on the dollar. That's nuts. So yeah, I think the Trump administration wants to get the dollar down. And look, like, we've talked about commodities before. Commodities have been in a secular bear market for years now. I think we're finally starting to see signs of life. And if Trump devalued the dollar by 10 or 15%, commodities, the whole basket would probably go up 15 or 20%. So.
Look, we have a lot of rebuilding to do with those commodities too. Los Angeles is now pretty much, there's parts of it that have burned down to the ground. You have the Middle East that has to rebuild many different places. So you're talking about infrastructure, steel, copper, concrete, all those things that these places are going to need. So commodities should get a boost at some point.
Yeah, and you left out Ukraine as well.
Yeah,
I mean,
my apologies. Yes, I did.
I think the war in Ukraine is going to end in 2025, and you'll have to rebuild there as well. I mean, basically, what you're talking about with all this stuff is like the two big ones are like lumber and copper. I don't really have a view on lumber. It's not very liquid. It trades like crap. It's I know lumber is very cheap right now. Um, I mean, $50 billion worth of houses burned down in California. You're going to need some lumber. I haven't even looked at lumber futures to see what they've done since the fire, and copper as well. But copper, copper doesn't really respond to these long term forces. Like it's really copper in the short term is really a play on China stimulus. If you think China's going to do stimulus, you buy copper. If you don't, you sell it. Like it kind of trades around China in the short term. So I don't, if you were to like figure out a way to do some big infrastructure play on all these areas that have been decimated, I'm not really sure what the smartest way to do it is.
So, obviously, we, like you said, recording this on Friday. A new administration comes in right after the weekend. What are you expecting? Obviously, tariffs are on the table, lower taxes are on the table, energy independence. There's a lot of talk about that. What are you expecting from the new administration in the short term to make things move in the right direction?
Well,
Or not?
in the short term, I think they're going to make the 2017 tax cuts permanent. That's going to be one of the first priorities. But I also think, you mentioned taxes, so I want to talk about taxes. We could be completely rethinking the U.S. tax code, completely rethinking it. You could see something like a Reagan 1986 tax reform that flattens rates and gets taxes down with a 2 on it, like getting like 28% or something like that. Um, Something as close to a flat tax as humanly possible. You could see that. I mean, there's, even some of the nut jobs on Twitter are talking about like abolishing income taxes. And as crazy as that is, like, Trump has actually been going around telling people that he can finance the government with tariffs and get rid of the income tax altogether. So the numbers on that don't add up, right? Like you can't finance the government with tariffs unless you dramatically reduce the size of government. But just the fact that people are talking about this stuff, like it's funny if you look at a chart of tax rates going back to Woodrow Wilson in 1913, like there used to be a lot of volatility in tax rates. We haven't had a lot of volatility in tax rates since 1982, right? Like when Jimmy Carter was president, the top rate was 70%. And Reagan brought it down to 50% a couple years later, and then he lowered it to 28%. And then George H.W. Bush raised it to 31, and Clinton raised it to 39.6. And we've been around anywhere between 35 and 39.6 for the last 30 years. There's really not been a lot of volatility in tax rates. As much as people made a big deal about the Tax Cuts and Jobs Act of 2017, taxes hardly moved at all. I mean, it was like a 3% cut in the top marginal rate. It was kind of a namby-pamby tax cut. So, like I said, I think people are going to be totally rethinking how we collect revenue in this country. You saw that Trump was going to start this external revenue service, right? Like not the internal revenue service, but the external revenue service to collect taxes and stuff. There's going to be some crazy ideas coming out, and some of them are going to be good and some of them are going to be bad. But before we got on the call, you asked me like about the roller coaster, like how are you enjoying the roller coaster? And I'm like, you haven't seen anything yet. Like the roller coaster has not even started yet. So
Jeez, we're still climbing up that first hill, right? Waiting for that big drop. It seems like we're on it, but I guess we've just sort of fastened our seatbelts and get ready for the ride. But I think your point is a good one. we need to think about taxes in a very much different way, because right now I feel like I'm working for the government. More than half my paycheck, the 39.6 is the federal rate. You then pay local taxes, you pay state taxes, and at some point you're ending up with less than half of what you've earned by
Yep.
working. So it's I think that's a good thing that somebody's thinking about some reform. But last time there was a tax cut, so people had some more money in their pocket, and then Trump instituted tariffs. This time it might work the other way around, where he's going to, on day one, he's going to try and institute some tariffs, and they're steep, but now there's talk of maybe implementing them slowly. We know there'll be some backlash from other countries, but the tariffs is really a tax on the American people, because they're going to end up paying more for goods, aren't they?
Oh yeah, I am not a fan of tariffs at all. I'm a big free trade guy. I'm a libertarian. I think the tariffs are a terrible idea. It's funny. I have a nephew. So one of the arguments I hear for tariffs from people is that other countries do it to us, so we should do it to them. And I'm like, look, two wrongs don't make a right.
Right.
So I started to say I have a nephew, and he used to live in China. When he went to school in China, and he would tell me that he would go to the grocery store in China, and he would go to the peanut butter aisle, and the Chinese peanut butter was $2, and the Skippy was $25 because of a tariff. And nobody bought the Skippy. Like, it was for sale, but nobody bought it because it was so expensive. And people look at that and they're like, well, they're doing it to us, so we should do it to them. And I'm like, absolutely not. Absolutely not. So
Why? Look, I get that Donald Trump wants to create manufacturing here and get that rolling. And that's one of the reasons why he wants to institute the tariffs. And look, he's ticked off at every other country for sort of taking advantage of America. But yes, manufacturing jobs went up, but they slowly dwindled down during his administration. So what is the net effect of tariffs anyway?
yeah, and I don't, it's funny, like, people romanticize manufacturing jobs, like, these are the jobs that we want, like these low skill jobs where somebody can show up and they put part A into slot B and they do that for 8 hours and they go home and watch The Simpsons. Like, I, I don't necessarily think we want people in manufacturing jobs. Like, those are tedious, stultifying jobs, right? Like, we want people in thinking jobs. Like, we basically want highly educated people that are in knowledge jobs. And the manufacturing, I mean, I like things the way they were in the 2000s. I like globalization. I liked it when China was paying people $1.50 an hour to make rubber doormats, and we imported them here and we sold them at Walmart for $4. And we didn't have somebody in the United States, making doormats like that. And it was deflationary. Like, we had no inflation. It was the most deflationary thing in the world. So I would like to go back to that, but it's not going to happen. And, tariffs and manufacturing things within the United States is inflationary. Things are going to cost more. It's just a fact.
How do we get you into the Trump administration? To be an advisor and say, look, this is the way things have to run.
They won't listen to me.
So what are you expecting out of the stock market in the first term? Donald Trump took the stock market from 20,000 to 30,000. Obviously, it's a lot higher now. What are you expecting out of the stock market?
I saw a headline today that said that the period between the election and the inauguration, that interregnum, has had this year has had the lowest return since 2009. And you also had the lowest return between Christmas and New Year's in like 80 years, like going back to like 1937. So usually stocks go up in the period between an election and inauguration. This time they really haven't. And one of the points I've been trying to make about this everybody thinks Trump is bullish for stocks. It's pro growth. It's expansionary. And look, like it was also true of Reagan. When Reagan was elected in 1980, people were very optimistic that Reagan would, uh, expand the economy and grow the economy. The first 2.5 years of Reagan's first term were a disaster for the stock market. Right now, things were different because you had Volcker that was hiking interest rates, and he caused a recession in 1982. But even still, like Reagan, was supposed to sprinkle fairy dust on the economy, and things were supposed to go up and to the right, and they didn't. They did later in his term around 1983, but it took a long time. I think I think the effects of Trump, his pro growth policies are priced in. I think they're fully priced in. And I think the first couple of years of his term are going to be tough for the stock market.
You're not really, you're not bullish on the stock market. You're actually out of stocks at this point. Am I reading that
I'm not
correctly?
totally out, but I sold a couple of weeks ago. I sold just about everything. Yeah.
What sectors, Jared, are you looking at? You think, okay, you know what, other than commodities, because we know that you're sort of, long-term commodities. What else are you looking at? You think, maybe this is going to do well under Trump.
Um, I don't know. I mean, look, I'm bullish on agriculture and fertilizer. I don't. That's not specifically a Trump play.
Okay.
And I'm just in the early stages of doing research on that. But it's more of a commodity play. Like we've had a bear market, not just in metals and energy, but also in agricultural commodities that's lasted for a few years. So I think that's over. Um, yeah.
Earlier in our talk, you mentioned Apple, and the Mag 7 has taken a fairly big or a sizable hit, actually. Do you find that tech is going to stay stagnant until people really figure out what AI is all about? I mean, we talked about manufacturing jobs. We can get robots to put tab A into slot B.
Yeah, actually, I read something interesting yesterday. So there was an interview with David Solomon, the CEO of Goldman Sachs, and he said, "Look, like we can create an S1, a prospectus for a stock offering in AI in 5 minutes. Like which used to take a team of 10 people 2 weeks to do. He says we can create 95% of it in like 3 minutes. And really, we just have to work on the other 5%. But think about that, right? Think of that's going to make a lot of people redundant.
Again, losing jobs. So, Jared, I want to ask you: are we better off at the end of 2025 than we were in 2024?
Are we better off, sort of like existentially? Like, I mean, I think so. I think we're better off most every year. Look, like I do think I am bearish on stocks, but I'm not bearish on stocks because I believe things are going to get materially worse, or we're going to have a recession or whatever. I mean, the stock market is expensive, and I think on a valuation basis, you can, it should be cheaper. But yeah, I'm excited about the incoming administration. I'm excited about what they're going to do with taxes. I'm excited about how Scott Bessent, who is one of the smartest financial guys you'll ever meet, how you have this guy in charge of debt issuance and fixing that problem. So yeah, I think we're in a better spot.
Earnings season, where banks have gone bonkers. What are you expecting from the rest of earnings season?
Yeah, I wish I owned banks. I saw that. There was actually I did own Goldman Sachs, and I sold it. I just like an idiot.
Can't win them all.
So I don't know. I don't pay a lot of attention to earnings like on an individual company level. You know, yeah, I honestly don't pay a lot of attention to it.
So what do you have coming up? What do you have? I know you're in the middle or beginning a new book to write a new book.
Well, I have three books that I'm working on, and one of them is going to be coming out this summer. It's called Rule 62. It's a essay collection. I'm working on a book about the awesome portfolio that's supposed to come out in 2026. I'm about halfway done with that. And I just started a novel, which is like a dystopian fiction novel that'll hopefully come out in 27. That's called Round Zero. So um, I'm working on those three things. And also, I have written up an options masterclass. So this is going to be sold through Jared Dillian Money. If you really don't know anything about options and you'd like to learn about options, this is a great class to take. So keep an eye out for that. That's probably going to come out in March or something like that.
Not the only class you'll have on Jared Dillian Money. You have a bunch of them that
Yeah.
people can take. So we'll get the URL to your website up there. So if someone wants to hear more about how you teach and the things that you offer, we'll get that up there. So Jared, thanks so much for joining me. Where can we find you other than Jared Dillian Money? I know you've got a Twitter account because I follow you, and the Daily Dirt Nap.
Yeah, just Jared Dillian Money, jareddillianmoney.com. That's the best place to find me.
And follow and subscribe to the Daily Dirt Nap. You'll get it in your inbox just about 5 days a week. I know you're taking Monday off for the holiday, so have a good day off. And thanks so much for joining me, Jared. I really appreciate it.
Yep, thank you.
Thanks so much for watching our discussion here on Wealthion with Jared Dillian. If you would like help with your wealth efforts, please head over to wealthion.com/free for a free portfolio review. Before you go, please like and subscribe to the channel, and don't forget to hit the notification bell so you hear about new videos. Follow Wealthion on social media. All the links are below in the description. And if you're looking for more ways to achieve long-term wealth, watch this video next.